Good afternoon, everybody, and welcome to today's webinar titled The Top 10 Financial Challenges Faced by Next-Gen Candidates. My name is Mark Keshgagian, and I am one of the partners here at Gray that heads up our McDonald's practice group. We are very pleased to have so many of you from all over the country with us today. We actually had a same webinar done at 10 o'clock this morning, Eastern Standard Time. We had a tremendous amount of people on that as well. We appreciate all of you for taking the time for what we feel is an important presentation. I hope you will learn something from it today. Before we begin, I just want to give you a little background about Gray and our long-standing relationship with McDonald's franchisees. We've been working with owner-operators for over 50 years and have developed a very specialized and dedicated McDonald's practice group. We provide all the services you'd normally expect from a CPA firm, including accounting and tax work, but we go well beyond the numbers for our McDonald's clients to include all the financial analysis and reporting that is specific to McDonald's and especially for you next gens. As a result, we've become one of the leaders in accounting services for McDonald's franchisees across the country, working with dozens of owner-operators on everything from business planning to rebuild and reinvestment strategies, personal financial planning, and the like. McDonald's is a vital core to our business, and we have become just as vital as a trusted advisor to our clients. If you have any questions, please feel free to reach out to me after the webinar is finished. So on to today's topic, the top 10 financial challenges faced by next gens. Before we begin, one technical point. If you have a question during the presentation, on the screen you should see a raise your hand button. I believe it's orange. In any event, just type in the question. We will get to it either right away or a little later in the presentation, or even offline if you choose, whichever is most appropriate. So let's begin. A little bit about myself. My name is Mark Keshgagian. There's a picture of me. A little bit of history. I've been working at Gray now for 31 years and have been working with McDonald's franchisees for the entire 31 year. Graduated from Northeastern University and started working in a smaller firm with McDonald's franchisees and have done that ever since. So I feel as though I've become very intimately knowledgeable in your business. Currently we serve 84 McDonald's owner-operators from coast to coast, most of which are successful next-gen candidates. I'm also president of an organization called NFCA, National Franchise Consultants and Accountants, and these are 9 firms that primarily have niche practices with McDonald's franchisees and focus many resources, time, and energy in getting to understand the McDonald's business. So let's talk about some of these challenges. First and foremost, and I put this as number 1, that top challenge, my parents are not eligible for growth and rewrite. So this is a big one. As you move through the program, getting 20%, and as you move to become an owner-operator, your parents' organization must be eligible for growth and rewrite. So if you're not sure of the answer, you need to know what the answer to this question is. They need to be a financially viable organization. So it's a great way to start off this webinar, because if you don't know the answer to that question, you should. And the very last slide of this webinar is, what is my role as a next-gen candidate in this process, and how do I differentiate myself with my parents? The answer to that, and we'll answer it in slide number 10, but the true answer to that is this is a joint partnership. So as you move through the program, as you begin to get your 20% and then move through the program to become approved as an owner-operator, that process must be jointly done with mom and dad. You need to form a partnership, and you need to be involved in every aspect of the planning that takes place with this process. So, you know, when we talk about their standing as an owner-operator, it's incumbent upon you to know what that is. And even more importantly, not what that standing is today, but also whether or not they're eligible years 1, 2, 3, 4, and 5. This process will take some time, and it's very important that that you are involved in mom and dad's business and that you're involved in the business planning aspect of it. There may be things that happen within their business, like an MRP, a major remodel, rebuild, relo, that could affect their viability. There are other things that could affect their viability. So you need to, there almost needs to be business planning that takes place. You need to be involved in that business planning so that not only do you know what mom and dad's eligibility is today, but what it'll be over the course of time, maybe the next 1, 2, 3, 5, 10 years. So very, very important to understand and know what their standing is with McDonald's Corporation. So I have done many presentations across the country to next-gen groups, and we have this really cool polling software that we use when we do these live presentations. And what it does is it allows people to use their cell phones and actually text a number in and respond to a series of questions that I will ask live. One of the questions that I've asked many of my audiences, and the good part about this too is you can do it in private so that you don't have to raise your hand in front of your peers. But one of the questions that I have asked these audiences is how much money they have. So, you know, a big challenge is I have no money. So on average, 41% of the people that I have polled as we've done these presentations have said they've saved more than $50,000, which means 59% of them have saved less than 50. And in fact, 15% of next gens stated that they have saved no money. You know, a next gen can be anywhere from a student coming out of college to somebody farther advanced in their career. So it is possible that as a next gen candidate, you haven't saved a lot of money. That's okay, as long as we know now that this is something that you want to do. Then you begin to put a plan in place to build cash. We're going to talk about building cash as we go through this presentation, but know that it's okay if on day one you don't have money. There are many ways that your CPA, your parent's CPA, your financial advisor can get you into the program with 20%. We'll talk a little bit about those in later slides, but it's okay to know that even though it is a challenge that you may not have money, it's okay, and we can put a plan in place to begin to build cash to get you where you need to be. The second question that I used to ask or poll my audiences was talking about credit. Credit history is very important. 48% of our next-gen candidates claim to have excellent credit, which meant 52 didn't have excellent credit. And I'm going to tell you this, it's okay as well. Now is the time to improve. Every single person, whether you're a next-gen candidate, whether you're a small business owner, whether you're a college student, whether you're in a different business, it doesn't matter. You should be attuned to your credit history. You should have a good idea and be intimately involved in what your credit rating is. It's very, very important. McDonald's cares a lot about this because it talks about your financial management as a person, as an individual. So if it's not pristine, it's okay. We need to put a plan in place to make sure that it becomes better. I will also say this. It's very important to communicate. Once you know if your credit history is not good, it's very important to communicate that to the team that is in place that's going to help you through the process. And that team is going to include mom and dad. That team is going to include most likely the QSCVP that acts as the quarterback to this entire process. That team might even include a finance director in a region that you're working with. It may even include one of your financial advisors, your CPA, or even some sort of a tax or estate advisor. Because usually when we talk about next gens, we're talking about mom and dad transferring 20% ownership of a restaurant to one of their sons or daughters. There may be other siblings that you have, so there becomes estate issues around all that as well. Not issues, but maybe even estate discussions. So not having pristine credit is okay, but let's at least recognize that and put a plan in place that's going to make that credit rating better. My educational background is not financial. Another way of saying it's okay. A lot of next gens have moved on to college, are studying in different fields, and decide to come back to mom and dad's McDonald's business. That's okay. The reason why I believe that the Next Gen program with McDonald's is so successful is that Next Gens come back and they bring some talent back with them to make this business a better business. So it's okay if you don't have a financial background. My suggestion would be to surround yourself with trusted business advisors. Surround yourself with CPAs, financial advisors. Work with your finance team in your region. Your finance teams are great. They have people that understand the business, understand the financial aspects of the business. Work with them. Educate yourself. Attend workshops, webinars like these. Many regions have next-gen teams that have regular meetings, profit teams. Just surround yourself with all of the people that are going to help you to become successful and that will help you to understand the financial side of the business. I'm not involved in the financial side of the business currently. So this is a big one. And the reason why I say this one is a big one is that you should be. A lot of, I see a myriad of different situations out there. I see next gens who get mom and dad's financials, the P&Ls for the restaurant. They don't even get the balance sheet. They just see the P&Ls. They've never been on FFS. That's not enough. Seeing the financial statements is not good enough. Each one of you, I've got to tell you, WebFFS is such a powerful tool. It is a tool that has so much information on it, but what's more powerful about that tool is that the company, the owner-operator, and the next-gen candidate, as well as the CPA and financial advisor, are all looking at the same information. So all parties can best advise. It's a great tool. There are so many things on there. We're going to kind of talk about them in future slides, but it's really, really important that if you haven't gotten onto FFS, do it. There's some great information on there. Mom and dad need to let you see that. There's also the tools, the financial tools that are available on the web, on FFS. The 5-year reinvestment tool, the profit generator tool, there's a break-even tool. There's many tools there that you should have a good understanding of how they work and what they tell us. But most important, over financial statements and WebFFS and McDonald's financial tools, is be involved in the decision-making process that takes place in mom and dad's business. What I mean is they may have a business review that's coming up. They may have had a pre-review. They may understand what their financials, their financial side of their business review is going to look like. You need to be involved in that process. You should be with them when they have their business review. When mom and dad are working with their CPA and putting action business plans together to decide what type of reinvestment projects need to be done in their business and when it makes the most sense to have those done, you should be involved in that decision-making process. You should understand what takes place. When mom and dad are sitting down with their tax advisor and they're going over tax planning throughout the year, you should be involved in that. So these decision-making opportunities you need to be exposed to. I can't stress more than having next gens really sitting side by side in a true partnership with mom and dad, making and being involved in the decisions that are taking place in the business, far beyond just seeing a set of P&Ls or a balance sheet. So really, 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 if you're not involved in the financial side of the business, get involved. Be the dynamo. We're going to talk about dynamos in a second, but be proactive and get yourself involved in that side of the business. It's crucial to your success going forward. Where should I focus? Where should my focus be on the financial side of the business? So ensure that the CPA that mom and dad is using is talking to you about these things, okay, going what we call beyond compliance. Compliance is the monthly financials. Compliance is tax preparation. Going beyond compliance is everything else. Reinvestment analysis, personal financial planning, tax planning, putting together business and action plans that make sense for your business. all of these things, store valuations, this is all going beyond compliance, all things that you need to be exposed to as a next-gen candidate. Understanding financial viability. This one's big. I don't know if you know this, but yesterday on FFS, Mom and Dad's organization is now able to see the new financial metrics, the new 6-point system that's going to be used in measuring financial viability going forward. You should have an understanding of what that ratio calculation sheet looks like. You should understand what cash flow coverage ratio is, what it means, why McDonald's places importance on that. Understand what the trailing 12-month liability turnover in days are. Understand what working capital is. But even more importantly, understand what transactions that you can do in your business that may positively or negatively impact any one of these ratios. For example, and I'll just throw one out there, with cash flow coverage ratio, things that affect that generally are increases or decreases in G&A, increases or decreases in draw, increases or decreases in annual debt service, and increases or decreases in the profitability of your restaurants. So in fact, in April, when Mom and Dad may be making a big tax payment and having to push a big outlay of cash through their business to pay taxes, that may have a negative impact on their cash flow coverage ratio. So it's understanding what types of things that you do in your business will affect the viability. It's very, very important. Business and action plans. You really, as a business owner, everybody, I believe, should have a business plan. And I tell my owner-operators this all the time. If you don't have a plan, McDonald's is going to put a plan together for you that may not be to your liking. So it's really important to be proactive and to understand what is incorporated in a business plan and actually get one done. Most of the regions, I believe all the regions now, they have what they call vision plan meetings. When they sit together as a team once, twice a year, but they look at each restaurant within that region. And they look at those restaurants independent of who owns them. So for instance, McDonald's restaurant on Main Street, USA, they're looking at that, not caring necessarily who owns it, but they're looking at the store profile. They're looking at the infrastructure and age of the store. And they're looking at what needs to be done to bring that store in working condition. And that may be an MRP, that may be a rebuild or a reload, and it may be next year, it may be 5 years out. But it's very important when you begin to put business plans together to understand what the vision plan is of each of the restaurants in Mom and Dad's organization. Because that gets incorporated in either the 5-year reinvestment tool or some other tool that your CPA may have, and it tells pretty much a picture of what that financial viability of that organization is going to look like in the years to come. Be involved and focus on ongoing tax planning. Mom and Dad shouldn't be finding out, and you as an owner-operator shouldn't be finding out in March what your tax bill is going to be in April. It's important to have ongoing tax planning throughout the year and understanding what affects that tax plan. It could be accelerated depreciation. It could be a major reinvestment project. It could be a bunch of things. But know that process must take place throughout the year, and you should be making decisions throughout the year to mitigate any potential tax increases you could have within the law. Personal financial planning, wealth management, retiring planning, exit strategies, they all go together. And the reason why I have this here is on this slide, even though you're a next gen and you're just coming into the system, and exit strategies may not be one of your primary concerns, it's important to know in any business. I'm a partner in a CPA firm, and even though I'm far from retirement, but I'm not too far from retirement, I need to have some sort of an exit strategy. I need to have some sort of a plan in place to know that when I do decide or have to retire from this business, that I'm going to be able to live the lifestyle that I choose. So Wealth management, personal financial planning, very, very important. There's college planning out there. You may have young kids. There's opportunities to be able to put money aside tax-free to pay for some of these things. There's IRAs. There's Keogh plans. There's all different types of vehicles. Understanding what wealth management is all about is really looking to see what your asset portfolio looks like, what it's made up of. Is there diversification? Are all your eggs in one basket? You really got to start to concentrate and think about that stuff. So it may be a discussion you may want to have with your financial advisor or your CPA. Understanding financial viability. Okay, when I went to college many, many years ago, 30, 32, 33 years ago, and I sat in Accounting 101, I'll never forget my professor telling us that cash is king. And he told us that we're going to take that throughout our professional career, and that's going to be pretty much the equation by which we live. Really, cash is king. I can't stress enough that as a McDonald's owner-operator, or even as a small business owner, cash is king. It's so vitally important to build cash in your organizations. Understanding your ratios, we talked a little bit about it, but you really need to understand what they are, what they mean, why McDonald's, why banks look at these things. We call these covenants, but they're also guidelines and measurements that basically tell us the financial health of your organization. So it's very, very important that you understand what they mean. Feel free to reach out to me or reach out to any one of your tax advisors. Reach out to any one of your CPAs that you're working with, but get to know and understand what these ratios are all about. The new 6-point system, it's a great system. It affords some owner-operators that wouldn't necessarily be financially viable to be financially viable because it looks at this holistically. It captures all three ratios together. For instance, your cash flow coverage ratio can be somewhere between 1.0 and 1.2, and you can still get points for being 1.0 to 1.2. But because you have positive working capital in your organization, and because you have cash, you've built cash in your organization, you probably have strong working capital, strong trailing 12-month liability turnover days, and be able to capture the 6 points that you need to become financially viable. It's very, very important to understand how that system works. Factors that affect viability. We talked a little bit about this. Within each one of those ratios, there's certain things that you do in your organization that can positively and negatively impact that. We have a little tickler sheet at Gray, Gray & Gray that our clients have access to that shows and identifies what some of those transactions, those things that could affect your viability positively or negatively. I can certainly get that to you if you just send me an email. It's good to know. It's good things to know. The quintile reports. McDonald's owner-operators have access to these. The CPAs don't have access to them yet. These are great reports. They're stratifications. Things are based on pre-tax cash flow, but it really measures your store apples to other stores and drills down into some really nifty factors. Great reports. If you haven't seen the quintiles, get onto FFS and look at them. They do say a lot. We use them all the time. Norm reports, we look at these a lot when we're looking at store valuations, when we're putting together business plans. Norm reports are great. You can also find those on FFS. Understand what they mean. They can identify sometimes some opportunities in the P&Ls. Contribution margin. Understand what contribution margin is. It speaks to the profitability of your restaurant. Know what your contribution margin is and how that impacts deciding if you happen to do an MRP or a rebuild, what pre-tax cash flow may fall to the bottom line based on the contribution margin of your restaurant. And this one's a big one, managing drawer and G&A. In economic downturns, or if the business is experiencing a downturn, we all have to make adjustments. As entrepreneurs, as small business owners, we need to make adjustments. We either need to look to become more profitable, or we need to look to make adjustments in our lifestyles, because our debt service, if we can't refinance and we have very favorable rates, there's not many other areas that we can make adjustments. But it's very important as a business owner to be able to make those adjustments so that you don't find yourself in a negative cash or negative equity position. So vitally important. This one I love. I may not be a dynamo. There's a great book out there if you're a reader. It's called True Professionalism by David Maister. He talks about dynamos, cruisers, and losers. I don't need to define a loser. We all have a definition of what we think a loser is. But a cruiser is somebody who comes to work every day and gives their all and goes home, comes back to work the next day, puts in a very, very productive day, heads down, gets the job done, and does it effectively, does it right. Comes in the next day, does the same thing. That's a cruiser. But what separates cruisers and dynamos is the dynamo is the visionary. Okay? The dynamo is the person that thinks outside the box. The dynamo is the person that is going to bring mom and dad's business to a different level. That's who a dynamo is. I believe McDonald's Corporation is looking for their next gens to be dynamos. People that are going to take that business to the next level. People that are going to add value, bring in some talent they've learned to make that McDonald's business a better business. It's energy and passion that drives dynamos. And I can't stress enough, that's really what you want to become. You want to become a dynamo. Here's a little bit of information about how do I acquire 20% ownership and eventually 51% ownership in the business. There are many avenues and vehicles we can use. Some are gifting, some are outright purchase, some are a combination of both. But it's incumbent upon you to create that team of mom and dad, QSCVP, CPA, finance director, and maybe an estate attorney to begin to piece together how you're going to get 20% and eventually 51%. You don't need cash. There are many different ways you can do this. We also take into account discounts, marketability discounts, minority interest discounts that help to drive the value down to make it easier and more palatable for you to get into the business. Which restaurant in my parents' organization makes the most sense for me? Again, a big question. We look at restaurant value. We look at the profile of the restaurant, the age, condition, and reinvestment needs of the restaurant. We look at the entity structure that mom and dad currently have in place. All these things become very important factors in how to get you into the business, get your 20%, and eventually your 51%. I'm struggling to transition from restaurant manager to restaurant owner. This is a big one. Technician versus entrepreneur. There's a huge difference between being a restaurant manager and a restaurant owner. A restaurant owner is an entrepreneur that requires a certain skill set. We're going to talk about, in my opinion, what I think that skill set is. But who is your entrepreneurial mentor? It may not be mom or dad. Mom or dad may not be the right person. It may be a fellow owner-operator that you know. It may be one of mom and dad's friends that's a fellow owner-operator. It may be the finance director. It may be the CPA. It may be somebody else. But you definitely should figure out who is going to be my entrepreneurial mentor. Who's the person that's going to help me to be a successful business owner? Who's that person that's going to help me to gain the entrepreneurial skills that I need? Who's that person that's going to allow me to think of my business as an investment that can grow over time? I can't stress more, get involved in the McDonald's committees, get involved in the profit teams, the next-gen teams, but most importantly, I have here, leaders are readers. I read a lot. I read a lot of management books. I read a lot of leadership books. You'll learn so much from that. We're going to go over in the next slide some of the things I believe are part of an entrepreneurial skill set, but very, very important. Read a lot, because leaders are readers. So let's talk about some of these attributes. Leadership, number one, being that visionary, being that leader. Entrepreneurs, successful entrepreneurs are leaders. Being able to lead. It's something that is very important, and you need to have leadership skills. Marketing skills. You know, in this business today, we have to figure out how to increase sales by guest counts. We have to figure out how to increase sales by menu optimization. It's important to have marketing skills. You know, we do a lot of marketing nationally. We do a lot of marketing locally within our regions. And we also do a lot of in-store marketing that we actually generate through our own creative marketing. It's very, very important to be a successful entrepreneur, to maintain leadership skills and have good, sound marketing skills as well, being creative. Communication. This one's big. Your words have the power to energize or quench passion. So as a leader, orally or through writing, your words have the power to energize and motivate people, or do just the opposite. So it's very, very important to build good communication skills. You can do a lot of this through reading. Be open-minded. Be a listener. Desire to learn from others, whether they be fellow owner-operators, some of your employees, your managers, your crew, people that you interact with every day. Always be open-minded. Always keep an ear open. Be a good listener, because when you talk about successful entrepreneurs, they are open-minded. They want to learn. So you have to be open-minded and be a good listener. Be focused and goal-oriented. When we talk about visionaries, you know, you'll have a vision as an owner-operator and as an entrepreneur. You need to be focused on that vision. You need to be goal-oriented. Don't lose focus. Don't get distracted by things going around you. Time management, big one. Being able to juggle all that an owner-operator needs, this is huge. You're managing restaurants. You have teams of employees that you're managing. You're on profit teams, next-gen teams. You have to attend McDonald's meetings, webcasts like today, and other webcasts. But most importantly, you probably have some sort of a family. So it's really important to be able to juggle it all, and being able to have a happy life at home, in my opinion, is one of the key attributes of being a successful entrepreneur. You got to be able to juggle all that, but you got to be happy at home, and you got to have a good, happy personal life so that your professional life will succeed. Persistence and persuasion. Rally your people. Failing to give people recognition or to express gratitude can be a major hang-up and a distraction to you becoming a successful entrepreneur. So you always got to rally your people. Every time you look at somebody, think that they have a sign that hangs from their neck that says, "Make me feel important." Your employees, your managers, your crew people, everybody that works in your organization wants to feel important. So be that business owner that rallies. Personal accountability. Hold yourself accountable. I just finished reading a book. It was a great book, and they talked in that book. I think the title of the book was "What Got You Here Won't Get You There." And the author, who's worked with several CEOs in the country and actually in the world, identified 20 different transactional flaws that can hold people back from being successful entrepreneurs. And one of them is passing the buck, the need to blame everybody but ourselves. You need to hold yourself accountable and stop worrying about or failing to give proper recognition where due. Integrity, trust, moral and ethically sound. This one's huge, and I have a quote there. It takes 20 years to build a reputation and 5 minutes to ruin it. Actually, it could probably take 5 seconds to ruin it. So important. Integrity, trust, this is how you rally people. This is how you as a leader can be a successful entrepreneur. And finally, financial literacy. being intimately involved in the financial side of the business, understanding everything we talked about on that previous slide, being able to put together a business plan. You know, one of the things today, I work with a lot of owner-operators. When there's an MRP project or a rebuild project that comes online, immediately some of my owner-operators are thinking, I got to 100% finance that. I don't have any cash. I need to 100% finance that. Well, guess what? 100% financing may not make sense. You may be taking on significant debt and not seeing a huge gain in cash flow over the first few years. That decision to 100% finance could change your financial viability. Vice versa. If you have a system initiative like a high-density kitchen equipment or something like that, you decide to take and pay cash out of your business for that rather than borrowing some short-term money at low interest rates, that cash outlay from your business could have a negative effect on your financial viability. So understanding how you're leveraged as an organization is so important. I'll give you another quick example. You know, I'm an owner-operator and I have 2 kids that are going to college. And it's going to cost me $80,000 this year, year 1. They're twins. So my drawer is going to be increased by 80 grand this year because that's going to come out of my business. Well, guess what? If that $80,000 is going to make a big hit on your viability and send you into a negative situation, maybe it makes more sense to have son or daughter go out and take an educational loan for their education, knowing full well that when the time permits, you will pay off those loans, thus paying for their education. But those types of decisions can really make an impact on your viability. So it's really important to align yourselves with financial advisors and CPAs that are going to help you think this way. You know what, and I'll give you another example. You know, with restaurants, I have a multi-store owner-operator with 10 restaurants, and they want to buy 3 more. And their passion is to own significant amounts of restaurants. Well, you know what? We have a lot of owner-operators that flip restaurants. Okay, they want to buy these 3, but maybe they're going to sell off 2. And really, what makes more sense at the end of the day? To say that you have 15 or 16 restaurants, or say that the restaurants you have generate the highest amount of cash flow that you can have, thus giving us the greatest value. So there's all these types of strategies that take place, and that's why financial literacy is so important when we talk about being a successful entrepreneur and a successful McDonald's owner-operator. Number 10, I'm unsure of my role and how it compares to my parents. I talked to you a little bit about this at the beginning. This has to be a true partnership. Okay, your role as a next gen is aligned with the role of your parent as an owner-operator. You need to work together throughout this process. So if you're not financially intimately involved in the business, get there. Talk to your parents. Tell them you want to know more. You want to get on FFS. You want to be involved in the decision-making that takes place. You want to be involved in the business review process. You want to understand their tax situation and what tax planning means and how to mitigate taxes. This is a true partnership, and also a partnership with your CPA and financial advisor to arm you with everything that you need to know to be a successful McDonald's owner-operator. I can't tell you enough. I work with a lot of next gens, and the ones that are the most successful are the ones that at day one were intimately involved with mom and dad in their business. So look at this as an opportunity. Let's not look back, but let's look forward about how we can partner together to become successful McDonald's franchisees. Utilize the resources, utilize the people around you, utilize the corporation, and I can guarantee you, with a plan in place, you will become a successful next-gen candidate. That's all I have. Again, if you have a question, feel free to type it in, and I'd be more than willing to answer it. You see my email address there as well. If, in fact, you have a question and you want to reach out through email, I'd be more than willing to help you out and help guide you. Mom and Dad, again, are your greatest resource. They are successful, at what they've done. And as a next-gen candidate in the program, there's some great opportunities there. This is a great business, a great brand, and has a very, very bright future. So again, I thank each and every one of you for taking the time today to talk. Over the summer, we'll be diving into financial viability for next gens even deeper. Just kind of wanted to give you a flavor for some of the things that you should know. But most importantly, use the resources at hand. Again, thank you very much for your time. And I also want to make note that on the next slide, we have a very important webinar coming up this Thursday. It's not on this slide, but I'm talking to you about it. You may not be aware of this, but there is a 2014 tax reform bill out there. It's not law, but it's a proposed law, and it severely impacts small business owners, specifically McDonald's owner-operators. Very important to tune into this very important webinar this Thursday. If you go online to our website at www.gggcpas.com/webinars, you'll see this one for Thursday. Very, very important. A lot of changes being proposed to tax rates, accelerated depreciation provisions going away, like-kind exchanges going away, some really important things. Also on Tuesday, April 8th, in line with the new National Franchising Financial Standard, we're going to be doing 2 webinars, one at 10 and one at 4, on the new National Franchising Standards. So feel free to tune into that as well and register for that. We also do webinars every month, so just if you felt this was informative, just check our website out. We do webinars every month relating to McDonald's franchisees. Again, happy that you joined me. If you have any questions, feel free to reach out. Good luck in your journey to become a McDonald's owner-operator if you already aren't, and have a great rest of the day.